Very good morning, ladies and gentlemen. My title, Katy Lied. There were a couple of immediate responses when we sent the invite out who said, well, if you name an investment presentation after a Steely Dan song, then I'm going to come to it. So, it is a line from a Steely Dan song from 1975. It's also an album title. The song was called Dr. Wu. You might have guessed I'm a bit of a Steely Dan buff. But Dr. Wu is all about heroin addiction. One of the great 1970s songs about heroin addiction. Just arguably the best known and possibly best song for the 1970s about heroin addiction was from 1971 and was the B-side of Lou Reed's Take a Walk on the Wild Side and was a song called Perfect Day. And the fact that that was about Lou Reed's heroin addiction sort of overlooked by the BBC when they made it the Children in Need charity record. Anyway, I never quite got that one. Anyway, my supposition is that investment markets are acting like drug addicts because they are hooked on quantitative easing. So I'm going to take us on a little journey, a journey into the world of drugs and addiction. And addiction starts with pleasure. Markets have got addicted to QE initially because it made them feel good. The central banks gave them free money and that was good. That made them feel nice, made them feel powerful. And from the pleasure you move on, and pleasure leads to dependency. And from dependency you go to craving. And after craving you get compulsion. And compulsion is when you start to get the breakdown of your day-to-day daily life. And after compulsion you get to dysfunction. You cannot operate without the drug. And my supposition is if you follow that through and think about markets and quantitative easing, that is precisely how they have been behaving. And we are in the situation now where financial markets are dysfunctional because they are addicted to quantitative easing and they cannot get their fix on it. And that complicates the bear market. So we're hooked on quantitative easing, my supposition. But what's gone wrong with quantitative easing? Because it started so well as unconventional economic tools, as unconventional monetary policy. QE for the first few years was a fantastic success. And it created, first time around, a desire to take risk. When markets got given free money for the first time, what did they do with it? They went out and bought commodities and invested into emerging markets. So actually, quantitative easing, first time round, actually helped to create the overvalue, with hindsight, the overvaluation, and it's not a bubble, but it helped to pump up commodity prices and it helped to pump up emerging market equities and to create value for emerging market debt. But that appetite for risk has now flipped 180 degrees. And my argument is now that quantitative easing, instead of creating a desire to take risk, is stopping people taking risk because it's created the zero mindset. We are in a world where we all know, or we think, operate, inflation is zero, give or take a little bit. It's going to stay there almost forever. Actually, it might get worse. Look at the oil price, look at commodity prices, look at China. Well, we're still being the ECB is still doing QE. If I invest and I get 1%, that's not bad, is it? And perversely, we're in the situation now, I think, that quantitative easing is 180 degrees counterproductive. And we are actually not going to get to a situation where the world starts to invest again until people think that they've got to get higher returns. another quick tangent. It's not a chart I've got, actually, which I had now. But if you chart American corporate bond issuance and US share buybacks, the two of them are bang on. The last 3 or 4 years, the corporate bond issuance, which has been funded by QE, that has paid for share buybacks. How much of that has been invested? In round numbers, nil. That has gone into earnings per share manipulation, arguably market manipulation, and into the executive drinks cabinets. And so when people speak about how quantitative easing is creating inequality in the world, that is exactly what they're talking about. American quantitative easing has gone into corporate bond issuance, which has gone into executive pay packets. It's not a healthy situation. I'm getting gloomy, aren't I? Right, okay. Let's do the Mr. Creosote bit slightly more. This is the chart of the DAX over 2 days in late October of last year. This was the time when Mario Draghi, president of the ECB, tried to explain to markets that QE is theoretically infinite. And the complication to this stems from a couple of years further back, when I'm sure you remember when Mario Draghi said that he would do, quote, whatever it takes to defend the euro, which he did utterly brilliantly. The unintended consequence of that is that markets now believe everything he says. So when he said we can potentially extend quantitative easing to an infinite level, they thought, I like that. I like that. How much of my drug is that? And whap, the DAX goes up. So let's come on to the wafer thin mint moment, when on the 3rd of December, Mario Draghi tried to quantify exactly what QE infinity meant. And on the 3rd of December, the ECB cut interest rates. The deposit rate, which was already negative, it took to being slightly more negative, and it extended the QE program by 6 months. 6 months at 60 billion euros per month works out at an additional 360 billion euros. That's a lot of euros, but it wasn't enough. The market wanted more, even more than that, and its response to being told that interest rates were being cut and it would have another 360 billion euros free was to drop the DAX by 4% on the day. That is a gluttonous drug addict saying that's not a big enough hit for me. That's not the healthiest situation, but let's not get too harsh on QE, shall we? Let's have a look at debt. And this extraordinary situation where in the years since the great financial crisis, the sort of homeopathic cure for having had too much debt that caused the crisis is to have even more of it. And let's have a look at how much more of it we've actually had. This is total US public debt from the 1960s. And in the years from the 1960s through to the start of the Great Financial Crisis, or the middle of the Great Financial Crisis, we go from roughly zero to about $10 trillion. In the 5 years since, we've put on another $8 trillion. So 40 years of American history to add on $10 trillion. And then the 5 years after the crisis adds another 8 trillion. Wow. But let's not be too harsh on the government. I mentioned corporates earlier. This is US corporate debt. And US corporate debt from 1990 through to the start of the crisis, we go from roughly 1 trillion up to about 3.5. And in the years since the end of the crisis, there's another 2 trillion gone on top of that. And you know where that's gone, because I've told you, that's gone into share buybacks. So let's not be too harsh on the States either, shall we? That's the UK public debt from the early 1990s. And that's showing us from the early 1990s through to the great financial crisis, we went from about £250 billion up to £750 billion. And the huge success of George Osborne's austerity since the end of the great financial crisis has meant that we've only doubled it since. So in the years since the end of the crisis, we've gone from £750 billion to £1.5 trillion. And so when George Osborne copies David Cameron's phrase and says, "We will mend the roof whilst the sun is shining," you can go back to your call my bluff days and go, bollocks. But let's not be too harsh on George Osborne. Let's have a look at what you and I have all contributed to this. This is household borrowing or household spending from 1997. And the blue bits above the line are where households are net paying off debt. That's paying down credit cards and paying down mortgages. The red bits below the line is when net household debt is increasing. So don't we know how good the UK consumer environment is at the moment, and strong retail, well actually the retail sales have been weak recently because it's been raining a bit, as we all know, but actually we know the economy is in quite good shape, employment's at record levels, real wages have started to rise, petrol's gone down a lot. This is all jolly good for the consumer, which of course it is. But actually, the increases in consumer spending are coming from increases in personal borrowing. Credit card debt, according to figures from the Bank of England, is increasing at an annual rate of about £2 billion. So not only are markets hooked on quantitative easing, but my supposition is that the developed world, the Western world, is also still thoroughly hooked on debt. And so far, we've all managed to get away with it. But things have changed. Because on the 16th of December, Janet Yellen said that the Fed is putting up interest rates. And there's a message from that, and the message is, this is the start of cold turkey time. But how do we do it? What's going to happen? What sort of experiment is this? It changes things. And my, again, supposition is that despite this only being a quarter of a point, this is the single most important change in global financial markets since the end of the financial crisis. Since then, equity markets, until the start of last year, nice steady uptrend. We've all built up debt. It's all been quite cosy since, actually. But the message from the Fed is that that's got to change. This is just the chart of the one-year Treasury bill back from 2006, just coming down from 5% down to almost zero, and we're now going back up. It's about 0.6, 0.7. But that is likely to be the start of a new trend. I'm going to do a cheery bit. Just a quick cheery tangent. If American interest rates are going up more, this is good news for the long end of the bond market. It's bad news for the short end, it's good news for the long end. If we look back at what happened to US Treasury yields in the 2004 onwards cycle, when Fed funds went from 1% to 4%, the yield on the 10-year Treasury went from 4% to 4%. So it should be that the further out you go, the greater your duration, that the markets will treat those bonds better, because they ought to view this as the Fed being proactively anti-inflation. What's my next? Oh yes. Statement of the obvious, that one, but I quite like the picture. Where are we going? I don't know. Nobody knows. This is the next step in the experiment. And what sort of worries me slightly is that we might get halfway across the bridge and then come back again. Last week's manufacturing data from the States was not terribly pretty. And we're in a situation whereby the markets are likely to think that with each nasty bit of data that the Fed has been preemptive and is going to have to reverse, or it will stick. The markets always come up with these corny phrases for it. It's now one and done. The last one was lift off. We've had lift off. It's now, is it going to be one and done? Could be. The problem, if we get halfway across the bridge and come back again, is that we're back into QE world again. And QE world is just perpetuating the problems. I think that whatever's on the other side of the bridge, and we don't know what it is, that's what we've got to go and face. Let's talk about oil. Let's get a bit cheery, because there's some great news about oil. The story of last year, really. Let's just explain it. This is a really complicated slide. It's actually that is as complicated as the fall in the oil price gets. Actually, it doesn't matter where you start. Let's just say, well, the oil price is going down. I don't know why. Can I explain it? Oh, well, it must be something about China. Can I find some data to tell me that China's not doing as well as it was? Oh yeah, well, I probably can, can't I? When if China's not doing so well, what does that tell us about the world? Oh dear, well, the world's not quite so good, and if I think the world's not quite so good, how do I make some money out of that? I'll short oil. And then somebody else says, well, why's the oil price going down? Oh, well, it must be something to do with China. Can I find some data? And round we go. And then we get to, let's chuck in another factor. We get the accelerant of the world's largest oil producer producing at its maximum capacity. And I'm buggered if I know why. And I don't know anybody else who knows why, but they are. And do you remember when you all did 11 plus economics and we all did supply and demand the first time round? Didn't we learn that the natural response when the price of something goes down is that supply contracts? You don't make so much of it. What has everybody done in response to the oil price going down? They've all pumped more. If the price has gone down, I've got to sell more of it, haven't I? So it's not difficult to explain why the oil, with hindsight, of course, why the oil price has done what the oil price has done. Chart of the oil price during my working lifetime so far. Because it's even on a scale this big, you can't see when I started work. But I'll tell you, it was 1986. 1986. And Ian and I were looking at this chart last week, and we were looking at it in the light of, I think it was Standard Chartered's latest forecast to say that oil could go to $10 per barrel. And we were sort of joking, as one does, might we have a giggle at work. If it goes to 10, well, why not 9 or 8? And then we said, well, about time somebody came up with a 0 oil price forecast, and we said, well, well, if it can go to 0, it can go negative. And do you know what the current price of North Dakota sour is? The current market price of North Dakota sour crude is minus 50 cents a barrel. If you are a producer of North Dakota sour, so okay, it's a tiny niche market and it's crap oil, but you have to pay the refineries to take the oil away from you. Negative oil has actually happened. Didn't see that one coming. But, okay, so we're a little bit down. What do we know? What do we know about the oil price? Well, at some stage, supply is going to contract. When we look at average production costs or national production costs, they are an average of two very different numbers. They are an average of how much it costs to get oil out of existing wells and how much it will cost to get oil out of a new well. And if we look at the US shale industry, just as an example, then the sort of average cost of getting oil out of existing wells is about $10 a barrel. For a new well, it can be up to 90. So the existing industry can pump away. And once it's got its sunk cost done, getting oil out of shale is very cheap. But it's very expensive to make a new well. So as and when they all start to run out, and shale wells have a very short lifetime, typically 2 or 3 years, nobody's going to be sinking any new ones. So it may take 2 years, it may take 3 years, but supply globally will contract. And then think also about the Paris Climate Conference Summit, whatever it was, last year, with this bizarre target to control global temperature. But anyway, that's just all part of, there is a tremendous willingness that we should all use less hydrocarbons and carbon targets. None of that makes sense at $30 oil. The solar industry doesn't make sense at $30 oil, nor does the wind, nor tide, nor actually does more or less any form of non-hydrocarbon power. To stop the world overheating, the oil price has got to go up. Who knows? It could go to $10. Of course it could go to $10. But give it 2 or 3 years, the world needs higher oil rather than lower oil. A quick one on Europe. Nobody's terribly interested about Europe at the moment because it's doing quite well, and nobody's interested in things that are doing quite well because they're boring. But the triple X year, I just like that. It's just a bit corny. Fix it is that people are worrying about Finland as being a country that might want to leave, but actually Brexit, I hate that word. I wish I never put it on the slide. The UK's EU referendum is the single biggest issue, I believe. Not only for us, because if we vote to come out, then I think, yes, the pound's going to go down a lot more. I think, yes, it is likely that Scotland will want independence, and Wales and Cornwall and Yorkshire and Lancashire and everybody will. But kind of globally, that's not the bit that matters. The bit that matters for the world is, well, if the UK's come out, what about Germany or France or Italy? So if we vote to come out, I think the technical expression on Investopedia is markets will crap themselves. It won't be good. The markets need a yes vote or yes to stay in and fairly quickly. The American presidential election in November. I know Hillary Clinton is standing for the Democrats, but after 2 terms of a Democrat president, it is highly likely that the next president will be a Republican, and it is highly likely, looking at that very recent opinion poll, that Republican candidate is going to be Donald Trump. And I cannot look at that picture of Donald Trump and not think of that. So, what is to be done, as Lenin asked in 1902? That's kind of the easy bit, to paint the picture of this is a tough year, but it's not the end of everything. There are ways through this. There are good ways through this. One, play it safe, Sam. For those who read yesterday's innovation, and I talked about Restaurant Group, companies which are missing earnings forecasts and have previously been standing on high or high-ish ratings are getting mullered. It's brutal. It is really important to try to avoid those. And industries with canaries, as I said, if Restaurant Group has warned about that particular bit of the market, who else is exposed there? Because we don't want to own those either. And if you can find good companies, great companies even, who are trading okay, and we're pretty confident that they're going to meet their forecast, and there are lots of those are pretty good places to be this year. There will be a big disparity between the okayers and the ones who miss their earnings numbers. And the key to this year will be not to own the profit warners. Be strong, be flexible, buy strong balance sheets, don't go for leveraged businesses, keep your bond exposure very flexible, because there will be times in the year when every bit of the bond market performs well. And there will be times in the year when every bit of the bond market performs not quite so well. So you need a good spectrum of bonds. Don't be panicked out of commercial property. I know your commercial property will mostly be open-ended, but we can't help that. It's not time to panic out of it yet. And finally, the absolute return funds, and I include structured products in there. Structured product. If you haven't been following the structured product market for years, you've been absolutely right, because value has been horrendous. It's brilliant now. If you can put up with a bit of volatility on the equity indices, there are some fantastic structured product bargains around now, and that's the first time I think I've said that since 2009. I think, am I out of time yet, Jill? Yes, right. Okay, the trainer's lesson, very quickly. I used to go to cork races occasionally. One time I was at cork races. One of the other people in the box was the mother of one of the trainers, and they have a big card at Cork. It's a mixed race. It's jumps and flats. I think it was a 14 race card. I bet on all 14 races. I think I won 2 of them. It was a good day. The trainer's mother bet on 4 of the 14 races, and she bet on the 4 races when she knew which horse was going to win. The lesson from that is you do not have to make every bet. Make the bets when you're pretty darn sure you know what the outcome is going to be. As Warren Buffett put it, if you're playing baseball, you don't have to swing at every pitch. So you do, and this gets into index tracking. The time that you have to bet on things that you know the odds are stacked against you are when you're constructing against an index or a benchmark or your index tracking. If you're doing, which we don't do, we proudly don't do that. I've said I don't care what the sector weightings in the FTSE are. I do not care whether the oil sector is 5% or 20%. It makes no difference as to whether we want to invest in it or not, what its weight is. What makes a difference to us is to whether that's a company that we want to invest into. And whether that is 1% of an index or 20% of an index makes no difference. Well, actually it does, because if it's 20, we're much less likely to want to invest into it. Volatility. Just finally, there is going to be volatility. Markets are more and more automated. They are driven by computers, not people. If you look at the turnover on Wall Street that is computer-driven relative to human-driven, it is terrifying. And when computers do it, there are no circuit breakers or safety. There will be market crashes. And they will be more frequent, and we've got to learn to deal with them. If you are an investor, they're brilliant because computer crashes deliver what I call irrational value. If you are a spender, and an awful lot of us have to deal with an awful lot of people who want to take money out of their portfolios, it creates a lot of problems. The traditional way of dealing with that is to fill the portfolio with lots of things that minimise the chance of ever making any money. Another way, arguably, is to say, well, if I know that's how much money you need out during the course of the year, instead of doing it on the quarter start date, I'm going to time it when I think the markets are good. I have no idea how that's going to play out, but the more automated markets get, the bigger a problem that becomes for all of us. So finally, Brownie points for the film? Ice Cold in Alex. Brilliant. Well done. It's going to be a tough year. It's a bear market. But if you work hard and you know the right paths to go on, it's going to be quite possible to get through it, and to get through it profitably. And there are double brownie points for anybody who knows what the link between Ice Cold in Alex and the title of the presentation is. And this was purely random. It was not deliberate. What is the link? Well, the presentation's called Katy Lied. Ignore the lied bit. Who said the ambulance? Peter, you're a hero. You and I, or people who've been to our previous presentations, are the only people in the world who know that the ambulance in Ice Cold in Alex was called Katy. Brilliant, thank you. I'll give you a clap for that. And that's all, folks. Thank you very much.